Okay, let's go ahead and get started here. So I've opened up the Q&A. If you have any questions, please list them in there, and then we'll go over those at the end. But thank you for joining today's webinar. We're going to talk about how you can easily find high quality stocks and beat the market. So let's jump right in. Most individual investors underperform the market. Here we're plotting on a log vertical scale the growth of $1 using different strategies. Now the S&P 500, you could see that in green over here. That has a 10.4% annualized return. That's your buy and hold strategy for a broad, diversified index. Below that, we have this yellow line. That's the average performance of mutual funds. We have 100 million plus Americans who are invested in mutual funds for the long term for retirement. And after fees, they do worse than the market over the long run. In fact, 70% of mutual funds underperform. And when you adjust that for funds that maybe died after a few years to the full 30 years of that study, it drops down to only 6% that actually outperformed the market. But it gets even worse. Here's retail investors in red at the bottom. Retail investors averaged 2.1%. They didn't even beat inflation. And so if you're finding yourself on this curve down here, the red curve, or if you've been investing with mutual funds on the yellow curve, losing to broader market indices, and you want to beat the market, then that's what we're going to discuss today. We're going to look at quality strategies. Here's an example with Value Glance. We'll dive into that more. I'll look at different models that return great compounding rates over the long run. But that's the goal here. How can we beat the market over the long run? We're going to look specifically at quality today. And so I'm showing you here the growth again of $1 by two different strategies. So one is the S&P 500, that's the buy and hold over the long run. And you can see going back 35 years, that returned, let's say around 9%, turned $1 into $18. But a high quality strategy, here shown in brown, grew at 16 plus percent compound annualized growth rate, turned $1 into over 200. So we're talking about a factor of 10x in terms of actual growth of a portfolio by the end of this time period. That's the power of compounding that we want to take advantage of. So how do we do that? Well, before diving in, let me introduce myself. My own background spans three different areas. The ivory tower. I have a PhD in theoretical physics from Stanford, a degree in applied math from Columbia. I am a numbers nerd. I love data. I love modeling mathematically how the universe works, including the complex system that is the stock market. Silicon Valley, I started a nuclear energy research company. And the finance world, I served as a research analyst and investment writer and worked on the portfolio team for a fund that was over 10 billion in assets under management, working at $1 trillion asset management firm. And from those experiences, I combined all of that into my book, Stop Checking the Price, which we'll talk about later. But today, we'll really break that down, take the key points out of that book to talk about quality investing. So here's what we're going to learn today. One, what is a quality stock? Two, how can we spot quality trends and multiply our value? Three, how can we quickly find these quality stocks? Four, how can we build our own strategy and test it on real data to actually prove that we have a market-beating strategy here? And then we'll end with a bonus, a gift for your own investing journey. Disclaimer, this is not financial advice. This is for educational purposes only. All right, now let's dive right in here. What is a quality stock? So unless you've been living under a rock, you're familiar with these brands. These are massive companies. We're talking about hundreds of billions in market cap, huge names. But just looking at them, how do we know which one is quality? Is it a tech company, shoe company, clothing company, oil and gas, retail, banking, finance, software? So how do we know which of these companies is high quality? What does that actually mean? And so we want to understand this. We want to boil it down to its essence and then use that for investing over the long term. So quality. What does a quality stock do? Well, it's a money printing machine. So quality stocks turn capital, meaning equity and debt, into big profits. So imagine our money making machine. We could think of it as a black box that's spitting out money. It takes in invested capital. That's money from investors. That's money raised from the bank. And it spits out yearly profit. NOPAT, the net operating profit after tax. But imagine each year the business is spitting out money. Fantastic. And so we can construct the key quality metric for us, ROIC, using these two quantities. The return on invested capital is exactly what it sounds like. It's the return. So in the numerator, we have the yearly profits. We see that's $50 in this example, divided by the invested capital. In this example, that's $100. So $100 goes into the money-making machine, and each year it's spitting out $50. And so that gives us an ROIC of 50%. So this is our key quality metric, and we'll see just how powerful this is. Full story. So a business spits out these yearly profits, but to pay for that capital, there's a cost of capital. And so we can see that's represented as $10 here, and that cost of capital goes towards the shareholders and the debt holders. So the investors that put up money to have equity in the business, and the bank, for example, that wants an interest rate. That's the debt holders. And so to service that invested capital, we have the cost of capital, which leads us to another important metric, what we actually want to compare ROIC with. It's called the WACC, the WACC, or the weighted average cost of capital. And we can compute this by dividing the cost of capital by the invested capital. So that's $10 in this example divided by $100. So a 10% WACC. Now, putting these two numbers together, we have our definition of a quality stock, a quality business. It's very simple, but it's very powerful. So an ROIC that's greater than the WACC means the business is creating value. And that's our definition of a quality company. And so we have our two numbers here. So the ROIC in this example was 50%, and then the WACC was 10%. So we satisfy this condition. In simple terms, imagine you take a loan out from the bank with a 10% interest rate. You go and use that money, that cash, to start a business that's generating 50%, and then you can take care of the bank, service that 10%, and have that 40% left over, which you can use to reinvest in the business. So that's our simple metric to get us going, but we want to see just how powerful this is. So let's look at a few examples here. This is the latest quarterly results, quarterly numbers, looking at that list of companies that we had earlier. So on the left, we have ROIC, and on the right, we have WACC. And so now using that simple metric, we can already begin to classify these companies. We may not have to know the details of them. We don't have to know who's running the company. We don't have to know how many people are working at the company. All of these fine zoomed in details. Instead, using these two key numbers, we can already say something about the business, whether it's creating value or not. And so going through this, Palantir, we see that's below. ROIC below WACC. Google, nicely above. Bank of America, 3% to 5%, pretty close by. Nike has a little bit of a gap there, 12 to 8. ExxonMobil, again, comparable, 7 to 8%. And then Costco has a nice gap here, 23 to 8. And so these are only this is only one number. This is a snapshot using the latest quarterly results. But already we're learning about this list of companies. Now, if we want to happen over time, we can plot the ROIC here shown in blue and the cost of capital shown in orange. And so this is a plot made using Value Glance. We're looking at long-term data here. We're looking at the long-term trends going back to the 1990s. And what we see is that the area is shaded red when the ROIC is below the WACC, and it's shaded green when the ROIC is above. And so we see there is this period around 2002, 2003, the ROIC jumps above the WACC. And so the question we might wonder is, well, was that a good time to buy Bank of America based on our condition? We're not talking about a snapshot anymore. Now we're looking at this long-term trend, and we may wonder, should we have gotten in? And so to understand this, we want to take a lesson from one of the greatest investors of all time, the man who taught Warren stocks, Charlie Munger. And so here's some wisdom from Charlie Munger. He said, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result. So he's talking about a high return on capital for a long time. Even if it looks expensive, you'll end up with a good result. So what does that mean? Let's unpack this a little bit. So here's our equation on top. So ROIC plus time equals value multiplier. And what we're showing in this table is the fair market value for, let's say, $1 inside of the business. The company has $1. They control that. They can put that dollar to work. And they get a return on capital of either 10%, 15%, or 25%. And imagine that business operates for 5 years. And so we ask the question, how much should we, the market, value that book value of $1? In this case, the cost of capital of the WACC is 15%. And so putting the numbers together, we see if the ROIC is equal to the WACC. Remember, that's not satisfying our condition of ROIC above. The value, the fair market value, is $1. In other words, $1 inside the business is $1 outside of the business because there's no new value being created. However, if the ROIC is 10%, it's below the WACC. We see that this value of $1 inside the business, the market value is only 80 cents. And the reason is that the business is destroying value. And so the $1 in the business isn't even worth $1 because as that business operates, that low ROIC means it's destroying value. Now, the flip side of this is our value multiplier. So 25% ROIC, nicely above the cost of capital, means that the $1 in the business that business can take and put to work is actually worth $1.50 today. And so that's a value multiplying effect. When you have high quality companies that can sustain this ROIC over time, we're willing to pay a premium. They're more value because of the value that will be created. And so we can take this and we can extend it out, not just 5 years, imagine 10 years, 20 years, 30 years. What happens? So for 15%, the story is the same. $1 inside, $1 outside. For 10%, we see it gets even worse. The longer the business is operating, the more value it's destroying. And so we would only want to pay 30 cents for a company that has $1 if it's going to operate for 30 years at a low ROIC. The flip side again, look at 25% for 30 years. We see this is a multiplier of 12x, meaning a company that can sustain a 25% ROIC compared to that 15% cost of capital for 30 years is worth 12 times the amount of value that's on the books. So that's the fair market value. If we can get in at a discount, even better. But what this is telling us is Charlie Munger's wisdom in a nutshell, that businesses which are high ROIC and steady over the long run, not just a snapshot, but a long-term trend, can create this value multiplier. And so that's what we want to be on the lookout for. Now we can summarize this in simple terms. Here's the epic handshake meme. So beating the market is the combination of quality stocks, that high ROIC, and time, patience, steadiness for the long term. So when we combine those, we get our market beating strategy. That's the essence. Now let's take a look at Bank of America again. So this is data from Value Glance. We're looking at the plot of ROIC over time. And now that we look at this and see the ROIC popping up there for a couple of years, does this look like a good quality investment? So what do you think? It's not exactly the steady trend that Charlie Munger was talking about. Instead, let's take a look at a different example that was on the list, Costco. So this is the ROIC of Costco in blue compared to the cost of capital in orange. And we see as a percentage since 2009, 2010, the ROIC has actually been increasing. So Costco has maintained a steady ROIC above the WACC since the late 90s. Since 2009, 2010, ROIC has actually been running away while the WACC has been fairly constant. We see a nice gap here. And so this satisfies our condition for a high and steady ROIC. So it's no surprise then that Costco was one of Charlie Munger's favorite companies. He said, find Costco's. Good exits. Don't look for your short-term timing. Don't look for a good short-term opportunity to get in and out. Think for the long term with high-quality stocks. Costco being a great example of this. And so this is the fundamentals. We're talking about ROIC, but at the end of the day, what does this mean for our portfolio? So let's take our two examples here. So we have Costco on top and we have the Bank of America on the bottom. You could see going back to 1990, they both started around $10 a share. So Costco around $9 and Bank of America around $11. So about $10 a share. And then we fast forward 35 years. Costco went from about $10 to $1,000. So that's a 100 bagger by 2025. Bank of America went to around $40 to $50 a share. And so we see our high quality company just continued compounding, reinvesting in growth, creating value, and that value is reflected for shareholders. But the low quality one, not so much. So to put some numbers on this, 14.2% return annualized for Costco, beating the market, a great investment over the long term. Bank of America, 4.1%. And so even if you add in dividends for Bank of America, maybe that adds a few percentage points, say around 7%, still Costco is like double that. So, and compounded over time. And so we're seeing with these two examples, we already highlight the advantage of quality and long-term value creation following the wisdom of Charlie Munger. So now that we know how to analyze these companies using ROIC, we can return to the next question. How can we quickly find these quality stocks? And so to cover this, I want to introduce you to here. And so this is value to make it super simple for beginners to find high quality stocks and invest for the long run. And so if we navigate over to the stock screener feature, we can pull this up and here we can put in whatever conditions we want to analyze. For our purposes, we're looking at ROIC, and we'll also include market cap here. And so imagine you want a, let's say 10 billion plus market cap. So we could adjust the sliders here. Let's say we want a 20% ROIC and above. So we click apply. And this narrows down the thousands of companies in the investable universe down to ones that are high ROIC. And so we see in this example, that's 133 companies. We can organize them by market cap. You'll see some familiar names here. So we have Apple, Microsoft. Let's go ahead and get rid of some of these other columns here to make it easy to view. So we have ROIC here and the WACC shown here. And we have the difference, ROIC minus WACC. So that's telling us about this quality gap that we're interested in. And so we see Apple, fantastic. Microsoft, nice. NVIDIA, a huge gap here. Google, nice gap, about 20%. Meta, so those are your big tech companies, tech giants. Taiwan Semiconductor. Lilly, so we're talking about healthcare now. We can even go in here. We can add in the sector. We can add in different industries so we can understand these companies. We see healthcare is high up here. So it's not confined to one industry that can generate high quality. We see financial services, Visa, MasterCard. Here's Costco, Netflix, entertainment, Home Depot. Again, healthcare, consumers. So it's sector agnostic here. It's industry agnostic. We're just narrowing down based on which businesses are actually producing long-term value. And so we see with the push of a button, we've narrowed down thousands of stocks. And if we want to go in deeper and analyze these further, we can click on these. And this brings us to the data visualization feature. So that would be the stocks tab over here. And now we can actually look at the ROIC and WACC over time. We can compare them, look at the quality. We can look at additional metrics. We're going to focus on quality investment. And then if we now go back here to our strategy, so go back here to our screener. If we want to go ahead and save our screener, we can do that. So call this ROIC 20. We could save that. And now we know how to find these high quality stocks. And so that's fantastic. We can find high quality stocks. But at the end of the day, just because Costco worked well and Bank of America didn't, how do we know that the strategy would have worked on real historical data? And so to do that, Value Glance is unique in that we can put these strategies to the test over the long run. And so that's what we can do with this backtester feature. And so the backtest allows us to go back in time through the historical database and apply a high quality strategy. And so the way that we can do that is going to create new backtester. Here we have some sample screeners. We have our customized screener here. So ROIC, here above 20%, market cap above 10 billion. Now we can choose annually or quarterly. And so this is how often per year we're trading and rebalancing the portfolio. And we could go ahead and run something like that, ROIC test. We could go and run the back test. Before our purposes, I already ran this in advance. So it'll take a few minutes to run. So this is the output of what it looks like. And so what we're showing here is growth of $1 using two strategies. So one, the S&P 500, you could see that in blue way at the bottom. That's turning $1 into about $20 over 35 years. And then we could see our strategy in brown here, the screener strategy. And that's using this high quality investing strategy. And so what we're doing is every quarter for the past 35 years, we filter the universe of stocks. We build a portfolio of different companies. So you can see them over here, portfolio companies, and we hold them for a quarter, and then we repeat that process. And what we see is very early, we crush the market here. And so we have a 16.3% return, taking $1 into over $200. And the S&P 500, again, turning $1 into 20. So we're a factor of 10 bigger in terms of our portfolio at the end of this strategy using high quality. So this is on a linear scale. We can even adjust it here to the log scale, and this allows us to clearly visualize what is happening. So you can see this is the log scale plot here, and we see the growth of the S&P 500. We can see a tech bubble, housing, and we see our strategy here in brown just continued compounding through all of that. So we're holding a diversified portfolio of high quality stocks for the long run, and we see that it beats the market, compounds away, and we understand why. And so that's the power of Value Glance, is that not only can you find high quality companies, you can analyze them, look at the long-term trends of the data visualization, and then you can actually go and test your strategy to prove how it performed over the last 35 years of real historical data on thousands of real companies to say, okay, this strategy survives through wars, through pandemics, through bull markets, through bear markets. Actually put your strategy to the test and see how you do. So here we've really covered quality investing. Value Glance doesn't stop there. We can also look at different value metrics, different growth metrics, cash flow. And so I encourage you to go ahead and check that, play around with all of these different metrics. But for now, we understand quality in a nutshell. And so here was that example we saw earlier. Again, turning $1 into over 200 at the end of the day. That's what's in your portfolio compared to the buy, hold S&P 500 going up and down with the market like everyone else. So if you want to go ahead and test out and build your own strategy, check that out on Value Glance, the backtester feature. All right, so to summarize what we've learned here. 1, quality stocks have a return on capital that's above the cost of capital. When the ROIC is high and steady over the long term, following wisdom of Charlie Munger, we get a value multiplier effect. Like Charlie Munger said, even if it may look expensive, if that business can continue to sustain that high ROIC, that will be worth it in the long run through pure value creation. So that's why ROIC is important. That's why we want to look at these long-term trends. So by checking out those long-term trends of how ROIC and WACC dance with each other, and if there's that ROIC gap sustained over time, we can find these high-quality companies. We don't have to look at the latest news hype. We don't have to listen to the daily noise that's distracting us from these long-term trends. And lastly, we actually put this to the test. So we did our back tester. We tested the strategy. We beat the market by buying high-quality stocks over the long run with a diversified portfolio. It's not short-term trading. It's not get rich quick. But by thinking for the long term, by following the wisdom of great investors like Charlie Munger, we can boil it down fundamental investing, quality investing, to these simple and powerful metrics for the long run. So I want to leave you with this Chinese proverb. The best time to plant a tree was 20 years ago. The second best time is today. So we like to add our own little spin on that. We like to say the best time to start compounding was 20 years ago. The second best time is today. And so with that in mind, I want to present our gift. So your shortcut to find winning stocks, valueglance.com. This is the tool that we built. We built it for ourselves. We built it for the readers of the book who reached out asking for a tool that can simplify the analysis of any stock and find winning stocks with the screener and actually test the strategy with the back tester. So if you want to check out ValueGlance, you can try the free version, no credit card required. And new users, you can get 50% off the first month using this checkout code, quality50. So use that at checkout. Check out the premium version of ValueGlance, run all the back testers you want, put your strategy to the test, analyze all of the companies, screen according to all of these key fundamental metrics. So please go ahead and check that out. If you want to do a deeper dive into the research, please check out our book, Stop Checking the Price. That's available on Amazon. You can get Kindle, paperback, the audiobook. We don't want to go deep into the math. We want to really simplify it just like we did today in this webinar. Not focusing on complexities and jargon, but really simplifying to key fundamental metrics. So you can check out that book on Amazon. And if you want to follow along for more free investing content, please check out our newsletter. You could scan this QR code here or visit valueglance.substack.com. We explore more quality, value, and growth metrics and the latest investing and trading news and advice for the long term. Again, not focused on short-term hype, focused on long-term investing to compound and beat the market. So please check out that free newsletter for more. So with that, I thank you, wish you good stock hunting. Follow us on YouTube for even more investing content in video format, and check out our tool, valueglance.com, to find winning stocks. So with that, I would be open to any questions that you may have. Check our Q&A. Okay, so here we have a question. What happens when ROIC goes down? So that's a good question. So we looked at the long-term ROIC trends here. We said, for example, Costco, ROIC was going up. That was a fantastic situation to be in. We saw that was a 100 bagger. What happens when ROIC goes down? So one, that means we're getting less NOPAT, less of those yearly profits. So that can be a sign of concern that the quality of the business may be going down. And so that's why we want to look at these long-term trends to see which way ROIC is heading. So again, look at those long-term trends. ROIC may be going down as the business grows. For example, it gets harder and harder to generate the same amount of profits as the business gets bigger and bigger. You eat up market share. So you want to check what the ROIC is doing and also look at invested capital, other metrics that can help you understand if that's due to growth or the quality of the business is deteriorating. Okay, another question. How does the strategy handle things like Federal Reserve policy? So the Fed, this is actually the content of my second book on the history of bubbles that are inflated by the Federal Reserve and central banks. But how does that strategy handle that? So we saw over 35 years of real historical data, we crushed the market. That doesn't mean there's no ups and downs. Of course, the market is volatile at the end of the day. We can't control that. And no one besides the Fed chairman can control what the Fed is doing. So I would say, again, don't zoom in and try and keep up with the latest news. Instead, zoom out, look at the long-term trends. Don't get caught up trying to read the Fed chairman's mind. Instead, listen to Charlie Munger, who invested for many decades. Listen to Warren Buffett, all of the great investors who tell us, look at these long-term trends of high-quality businesses and ignore the daily nonsense in the news. Okay, so it looks like all the questions. So again, thank you for your time. We'll make this available online. Check out Value Glance, and we would love to hear any of your additional feedback. Otherwise, thank you so much again for doing it.